Welcome to today's essential guide on mastering your credit in the home buying process. Did you know that improving your credit score by just a few points could potentially save you thousands of dollars over the life of your mortgage? For many, purchasing a home is one of the most significant financial decisions they will ever make, and the state of your credit plays a pivotal role in determining the terms of your mortgage, from interest rates to loan approval. In this video, we'll explore critical credit do's and don'ts that every prospective homebuyer should know to maintain strong credit and secure the best mortgage terms possible. From the basics of credit scores to specific strategies tailored for the home buying process, we've got you covered. Whether you're a first-time buyer or looking to move up the property ladder, these insights will prove invaluable on your journey to purchasing your new home. Let's dive in and set the stage for successful home ownership. Before we delve into the nuances of managing your credit, it's crucial to grasp what a credit score is and why it's so important in the home buying process. Your credit score is a numerical summary of your credit worthiness, which lenders use to determine the risk of lending you money. A higher score can lead to better mortgage terms, such as lower interest rates, which translates to lower monthly payments and substantial savings over time. In this section, we'll break down each component of the credit score: payment history, credit utilization, length of credit history, types of credit used, and recent inquiries, and explain how each influences your mortgage prospects. Payment history is the most heavily weighted factor, accounting for about 35% of your credit score. It reflects whether you have paid past credit accounts on time. A history of timely payments is seen as a strong indicator of future performance. Conversely, late payments, defaults, and bankruptcies can significantly damage your score. Credit utilization ratio, which measures how much of your available credit you're using, also plays a critical role. It is advisable to keep this ratio below 30% to avoid negatively impacting your score. For instance, if you have a credit limit of $10,000 across all cards, you should try not to carry a balance higher than $3,000 at any time. The length of your credit history adds depth to your credit report and can enhance your score if managed well. A longer credit history provides more data points and helps lenders make more confident decisions. The types of credit used, such as credit cards, installment loans, mortgage loans, and more, show your ability to manage a mix of credit products. Finally, recent credit inquiries, which occur when lenders check your credit during the application process, can temporarily lower your score if too numerous. Now that we've covered the fundamentals of what makes up a credit score, it's crucial to dive into the specific actions you should take and avoid to maintain a healthy credit profile during the home buying process. In the next section, we will discuss the proactive steps you can take to ensure your credit is in the best shape possible when applying for a mortgage. As you prepare to apply for a mortgage, certain positive credit behaviors can greatly enhance your credit profile and improve your chances of securing favorable loan terms. In a recent Fannie Mae report, it was found that first-time homebuyers had an average credit score of 746 in 2023. This section will outline essential actions such as timely bill payments and managing credit card usage, which can strengthen your credit score, the most crucial factor in your mortgage application. Understanding and implementing these practices can be the key to unlocking better interest rates and terms on your mortgage. Another important aspect of credit management is the responsible use of credit cards. It is essential to keep your credit utilization low, ideally below 30% of your total credit limit. Managing how much you charge to your cards and paying down balances can help maintain or even improve your credit score. This shows lenders that you are capable of managing debt responsibly without relying too heavily on available credit. Consulting with your mortgage lender before making any significant decisions or changes to your financial situation is also advisable. Mortgage lenders can provide tailored advice that considers your long-term financial goals and the specifics of your mortgage application. Their insights can help you avoid steps that might inadvertently lower your credit score or negatively impact your loan approval chances. While these positive actions can strengthen your credit, it's equally important to avoid common pitfalls that potential homeowners often encounter. The next section will delve into the missteps to avoid during the mortgage application process, providing clarity on actions that could potentially harm your credit and jeopardize your chances of purchasing a home. While there are several proactive steps to boost your credit score, there are also critical pitfalls you must avoid during the mortgage application process. Missteps like applying for new credit or maxing out your credit cards can have detrimental effects on your credit score. This section will guide you through common mistakes to avoid, helping you maintain a strong credit profile that appeals to lenders and ensures you get the best terms possible. Another common error is maxing out credit cards. High credit card balances can lead to a high credit utilization ratio, which is unfavorable in the eyes of lenders. Keeping balances well below your credit limits, particularly under 30%, demonstrates to lenders your ability to manage debt prudently. It also helps maintain or improve your credit score, which is advantageous when securing a mortgage. Consolidating debt onto fewer credit cards is another action to avoid. While it might seem like a tidy solution to debt management, it can appear to lenders as if you are maxing out those cards, which may negatively impact your credit score. Instead, maintain a balanced distribution of your debts across multiple credit lines to show controlled and responsible credit usage. Additionally, closing older credit card accounts can be detrimental. Such closures may shorten your credit history and adversely affect your credit utilization ratio, both of which are important components of your credit score. Keeping older accounts open, especially those with a positive payment history, can benefit your credit profile. Lastly, major purchases should be postponed until after closing on your home. Large expenditures, whether paid by credit or depleting cash reserves, can raise concerns with lenders about your financial stability and debt levels at a critical time. While these don'ts help navigate the financial decisions that might impair your creditworthiness during the home buying process, there are also special considerations to keep in mind. In the next section, we will discuss additional tips and concerns, such as co-signing loans and managing old debts, that are crucial for prospective homebuyers to understand. Beyond the basic do's and don'ts of credit management, there are special considerations that prospective homebuyers should be aware of. This includes understanding the impact of co-signing loans and managing old debts. This section will discuss how these factors can influence your mortgage application and offer strategies to handle them effectively, ensuring you approach the home buying process with a robust and optimized financial profile. One important aspect to consider is the implications of co-signing loans. Agreeing to co-sign a loan can be a generous gesture, but it comes with high risks. When you co-sign, you assume responsibility for someone else's debt, effectively linking your credit score to their financial behaviors. If the primary borrower fails to make timely payments, it will directly affect your credit score and potentially jeopardize your ability to secure a mortgage. Therefore, it is crucial to think very carefully before co-signing, especially during the mortgage application process. Additionally, managing existing debts, especially those in collections or marked as charge-offs, requires careful strategy. Rather than paying off these debts immediately, which might not improve your credit score and could deplete your funds needed for down payments or closing costs, it's advisable to work with your lender. They can guide you on integrating these payments into your mortgage arrangement, possibly through escrow, or advise on negotiating with creditors to have these marks removed from your credit report upon settlement. Another consideration is the timing of financial changes. Once pre-approved for a mortgage, it is critical to maintain the status quo with your finances. Major shifts in your financial landscape, such as moving money between accounts or making unusual deposits, can raise red flags with lenders. It's important to document any significant financial changes or deposits, as they could be scrutinized for evidence of loan eligibility. Understanding these nuanced elements of credit management can be as crucial as the basic do's and don'ts. By keeping these special considerations in mind, you can avoid common pitfalls and position yourself as a reliable borrower, ready to navigate the complexities of the real estate market. Managing your credit effectively when buying a home is about much more than simply keeping a good score. It involves strategic planning and a deep understanding of how various financial actions can influence your mortgage application. From paying bills on time to avoiding new credit, the guidance provided in this video aims to equip you with the knowledge necessary to navigate the complexities of mortgage approval processes. Remember, every financial decision you make in the run-up to purchasing a home should be considered through the lens of its potential impact on your credit. Maintaining open lines of communication with your lender. Managing your debts wisely and staying informed about the implications of each financial move are crucial steps towards securing a mortgage with favorable terms. By following the do's and don'ts outlined, along with considering the special factors discussed, you can enhance your creditworthiness and position yourself as a desirable candidate for lenders. We hope this video serves as a valuable resource as you prepare for one of the most significant investments in your life, purchasing a home. Thank you for watching, and we wish you the best of luck in your home buying journey. Remember to consult with financial advisors or mortgage specialists for personalized advice tailored to your specific circumstances.